Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are continuing with our FM pre-December 2024 mock exam debrief. This is the first question of your section C. The name of the company is Nexus PLC. So Nexus PLC, a prominent player in the automobile industry, is in the process of planning to set up its own engine oil processing plant. The initial market survey incurred a cost of $25,000 and the investment of setting up the plant is estimated to be $800,000. This new project life is expected to be 4 years and the company expects scrap proceeds of $250,000 at the end of the project. Demand projections for the 4 years are given to us as follows. The selling price per liter is $100, variable cost is $30. Annual fixed cost is estimated as $100,000, which includes $60,000 of depreciation and $10,000 of apportioned headquarter cost. Nexus pays corporation tax at a rate of 33% and is payable 1 year in arrears. That means if you are earning in year 1, you pay tax in the second year. Additionally, working capital equivalent to 10% of annual sales is required at the start of each year, recovered at project completion. Nexus company has a cost of capital of 10% and the company can claim tax allowable depreciation on a 25% reducing balance basis. The CFO suggests using NPV for investment appraisal, emphasizing the method's alignment with long-term objectives. However, some finance managers express concerns as the performance evaluations and compensation are more tied to annual profits. So this is a very typical question of the investment appraisal syllabus area. Very typical of, questions like these to appear in the exam. Nothing very difficult, nothing very complex. Simple, easy to solve question. 12 marks worth, you have to just calculate the NPV and find out the financial acceptability. Basically, you have to comment depending upon what NPV you get as your answer, should the project be taken up or not. So we start off with the NPV calculation. I quickly prepare the format. So first you need to take the particulars. Then there's year 0, 1, 2, 3, 4. And because we are paying tax 1 year later, we also need to take for year 5. So the very first top line item in any consideration is the sales income, sales revenue. How much will your sales revenue is going to be? See, we have the demand given and we have the selling price given. There is no information given to us with respect to inflation, so we will ignore that. So in the first year, you have 2,000 units and the selling price for one is 100. So every year, whatever is your sales, that will be multiplied by the selling price. So 4,000 multiplied by 100, then you will get 6,000 multiplied by 100, and in the fourth year it's going to be 8,000 multiplied by 100. So this is what your sales income, sales revenue is going to look like. Now the next thing we need to take is for the variable cost. Variable cost also is given to us as 30 per unit. So 30 multiplied by 2,000, which is our sales or the demand. Then you have 30 again multiplied by 4,000. Similarly, you have 30 multiplied by 6,000 and then 30 multiplied by 8,000. So this is how you have worked out the variable cost. The next thing that you need to take is for the fixed cost. Now the question is, out of the amount which has been given to us, what do we consider? So it tells you that $100,000 includes $100,000 is the fixed cost which we have estimated, and out of this $60,000 is depreciation. Remember, when we consider NPV only takes for cash flows. Depreciation being a non-cash expense, it will be totally ignored. So that makes your fixed overheads 100 minus 60, which gives you 40. Now the story is not over yet. There is another apportioned headquarter costs of $10,000. Apportioned headquarter cost means this cost will still be incurred whether this project is taken up or not. So that means this is not dependent, or this is not incurred as a result of taking this decision. So this is also not relevant. So that means so far we were at 40. Now we will subtract 10 also from the 40. So we are left with 30,000 every year as the fixed cost. So you will put 30,000 over here, copy and paste it to the remainder of the years. Now with this, you will get your operating cash flows. Operating cash flows will be revenue minus variable cost minus the fixed cost. You can copy paste the formula to the rest of the cells also. It will save time for you. Now the next thing that we need to do is account for tax. For tax, we are going to have to take for the tax benefit also, and the tax that we will be paying on the cash flows as well. So let's do a working. I will create one bifurcation here to let the examiner know that this is where I'm starting my working from. So I scroll a little to my right, and here I will use this space for my working. I label it that this is my working space. So my first working is going to be, always label your working. Working 1 is going to be about the tax benefit and TAD. So let's have a look here. We have 4 years, 1, 2, 3, and 4. And we are investing in the beginning $800,000. So this is my initial amount. Initial amount is $800,000. Now on this amount, let's read the information with respect to the depreciation again. Company can claim 25% tax allowable depreciation on a 25% reducing balance basis. So the tax depreciation will be 25% of this figure. So what I'm going to do is I'm going to by default take it as a negative. So my savings or the benefit that I will get, benefit will be how much? It's given we are paying tax at the rate of 33%. So 33% of this amount will be my benefit. I have put a minus sign before I selected the depreciation amount because I want the benefit to be shown as a positive figure ultimately when I use it over here in my main answer. That's why I've put a negative sign here. Now my opening balance becomes the difference between these two. In the next year, I have this as my balance. Now on this balance, again, I'm going to be using 25% depreciation. So this is going to be 150,000. Similarly, you can copy the formula, paste it over here, 49,500. Now you can do this copy pasting work for the remainder of the years. 450,000, copy paste this formula also, and copy paste this formula also. Now, when it comes to the last year, do we have any recoverable value? Scrap proceeds are given to us at the rate of $250,000. Now let's have a look here. How much is going to be the balance? So at the last year, you're left with 337,500. Over this figure, you're going to be getting a benefit of tax allowable depreciation of this much. Now, due to the fact that there's a difference between what is your written down value in this year and what you're getting at the end of the life that is given to us as $250,000. Now, the depreciation is going to be calculated on the amount of the difference. So you take 250,000, subtract from this. This is the depreciation that you can claim in this year. Now, on this amount, you will be getting a benefit of 33%. So you copy and you paste the formula here. So you will get the depreciation of your last year also. Now this is our working, and now we can move back to our question. So we are first applying for tax, which is there on our operating cash flows, tax at the rate of 33%. So the first year's cash flow, because tax is paid a year in arrears, it was written here, payable 1 year in arrears. Because of this, first year's tax is going to go in second year. So what we'll do is we'll place a equal to sign minus this figure multiplied by 33%. So this is your tax amount. This will be paid in the second year. Second years will be paid in the third year. Third year will be paid in the fourth year. Fourth year will be paid in the fifth year. So this is your taxation amount. Now we will take for the TAD benefit. TAD benefit, we will simply take away from our workings, and we will mention here that we have calculated, we have shown this calculation in the first working note. So we will just be linking the cells now. This is going to be 66,000. Second or the third year is going to be this. Next is going to be this. And the last one was this value right here. Now we did not, because this is a positive amount, so we need not place a negative sign here. This will give you this as the TAD benefit that you are getting in each of the years. The next thing that you need to take for before you arrive at your final answer is the working capital. It is written that 10% of the annual sales working capital is going to be needed for us. So for the working capital, let's do the working. We will create working note 2 for this. I could have done it directly also, but just because this is a step-by-step debrief, I am showing you the entire calculation. This is our working capital. We have 4 years. In this, what we are going to do is we will start from zero, because for the production in the first year, you are going to need the money right now. That is the only way at the end of the year you will be able to have goods produced with you. So firstly, you have the sales with you. Let's have a look. Let's put the sales from the numbers that we have calculated in the question. Sales are right over here. This is C4, so this must be D4. This must be E4. Then for the fourth year, it will be F4. So this is the sales figures which I have pasted here. Next, I need to find out how much is my working capital requirement. So my requirement is going to be 10% of this amount. So I multiply this with 10%. Now I copy paste this figure and paste to all of the cells. Now, how much is the incremental? That is what we will post in our final working. So we now know our working capital requirement. So in the first year, we are going to have a negative outflow of 20,000. Now in the next year, for needing the production that I need to do in the second year, I need to have money at the end of the first year. So I need 40,000, 20,000 I already have. So I need 20 more. So equals to, you can start off this by taking minus this plus this figure. That will give you the answer. So before the start of every time period, you're going to need this much amount of money. The formula is not working. Here you need 60. You already have a total of 40 with you. You will take the minus of sum of these two. Yeah, and ultimately put a negative sign in front. This is how you will arrive at this, but otherwise it's very easy. Every year you require 20,000 more, so you can simply take 20,000 more every year. Now in total, if you see, you will be having 4 times you have given 20,000. So at the last, you are going to have all of this money back to you. At the end of the fourth year, you will have 80,000 back to you. So now you've done the working capital calculations also. Now we will be putting the numbers here. In the first year, I take negative 20,000. Just link the cells from there itself so that the examiner knows where you get your numbers from. All right. So if this was K17, this is going to be L17. This is going to be M17. This is going to be N17. And this will be O17. So this is your working capital numbers which you have input. Now the next thing is going to be about the initial investment and scrap value. Let's put in those numbers also. Initial investment is minus 800,000 and the scrap value is given to us as 250,000. So at the end of the fourth year, you're going to have 250,000 with you as the scrap proceeds. Now let's have a look at the final cash flows. Cash flows. So you're going to use the sum function and you're going to start from the operating cash flows and drag it right till the end. So in the very first year, this is what it's going to look like. You drag it to the remainder of the cells also. So this is what your final cash flows are going to look like. Minus 820, 90, 259, 700, 337, 768, and negative 146. So this is the cash flows that you have gotten. Now what we are going to do is find out the NPV using the NPV formula in the spreadsheet. Equals to NPV, you open the bracket. The first thing that you need to do is type in the interest rate. That is the cost of capital is given to us as 10%. Then you select all of the cash flows that are given to you. Then you close this. And finally, what you're going to do is, because the initial investment is already in negative, you will put it as a plus and then hit enter. The final answer will be this value that you are getting over here. You can convert it to customs. So this is what it is going to look like. This is the positive NPV which you are getting. Now the question is not done yet. You also need to comment on the financial acceptability. So the comment, you're going to lay down the word comment over here and write down that since the project has a positive NPV of 163,813, the project is financially acceptable. It will add to the wealth of the shareholders. Right, so this is your comment. Now we are fully done with this 12 marker question. Moving ahead to the second part now. Second part wants us to discuss two differences between NPV and IRR. And we also have to talk about the context of mutually exclusive projects and tell them which method is going to be preferable. So let's first talk about the differences. If you talk about NPV, NPV is an absolute measure. It can be used to, compare projects of different sizes. But IRR, because it's a percentage, it's going to be something relative. So it ignores the size of investments. So you'll put this over here. Firstly, NPV is an absolute measure. Compare projects of different sizes. IRR is a relative measure. Cannot compare projects of different sizes. This is the first difference. Then you need to give two differences have been asked. So next we will talk about, if you know the cost of capital correctly, it will tell you exactly how much shareholder wealth it is going to increase for you. So this way it is directly linked to the objective of the company, which is wealth maximization. If you talk about IRR, it just gives you the rate of return that the project is giving you. This can show you how, good the project is, how attractive the project is, but it does not tell you how much increase is it going to give in the wealth of the shareholders. So you can say that NPV is linked to shareholder wealth, which is the main motive of financial management. Why? Because it shows you the absolute increase in shareholder wealth. And you will talk about IRR. It's a return on project. So does not tell how much increase will it generate in shareholder wealth. So this is how you will write this one. And finally, what has been asked with respect to mutually exclusive projects, you will say that whenever you're talking about mutually exclusive projects, IRR may rank the projects in a different order than the NPV method. IRR basically assumes that any cash flow that you generate, that means the ones that we have calculated yearly in all of the years, those cash flows will also be reinvested using the project's same IRR. That means how much return the project is giving you, the money will be invested somewhere else where you will be getting the same amount of return. But this assumption is not realistic. The more realistic assumption is the one which the NPV method takes, which is that the cash flows will be invested at the cost of capital. That means if my cost of capital in this case is 10%, any money that I generate from this, the money which I am making in year 1, 2, 3, ultimately till this project is ending, that money will be invested at the rate of 10% per annum. So this assumption is more realistic. That's why when it comes to mutually exclusive projects, the NPV method is more superior to the IRR method. NPV more superior because of more realistic assumptions. So this is how you will write the answer for this one. Obviously, I have just given you the main points. This is something which you can use to frame your answers. These are the main key points which you can put down here. Then moving to the very last question that has been asked over here, which is with respect to a comment that you have to make on the finance manager's preference to NPV for investment appraisal. So the main reason why finance managers prefer the NPV method is because NPV is based on the assumptions which maximizes the shareholders' wealth. The managers over here, which are saying that our bonuses depend upon the annual profits, they are prioritizing profits over NPV only because the compensation or the short-term metrics are dependent upon the compensation that they get is dependent upon the short-term profits. But this can be a problem where managers will be focused too much on short-term and they will not care about what the company is going to do in the longer term. So the managers may be unwilling to take this risk to have such a big expenditure that is only going to give you long-term returns. So and the managers usually don't adopt NPV method. This is the comment that you're going to put over here. And with this, we are through with the first case study, Nexus PLC. Thank you so much for watching this video. I hope that this has been useful for you. All the very best for your exam.